There is a single, fundamental truth that separates the fortunes of the 99% from the enduring dynasties of the 1%. It's not a complex algorithm, a secret trading signal, or privileged information whispered in a boardroom. It is a simple sentence, a 14-word promise that, once truly understood, acts as a permanent shield against the single greatest destroyer of wealth in the modern world: emotional decision-making. That sentence, gifted to the world by a quiet man from Omaha, is this: price is what you pay. Value is what you get. It sounds deceptively simple, like a folksy proverb you might see embroidered on a pillow. But within those words lies a mental model so powerful it can transform a terrified, news-watching retail investor into a calm, methodical opportunist. It is the genetic code of value investing, the core principle that allows you to see a stock market crash not as a catastrophe, but as a Black Friday sale. It's the reason a falling stock can, and often should, be a source of joy, not fear. Most people live their entire financial lives trapped in a dangerous illusion, believing that the ticker symbol flashing across their screen is the company. They see a stock price plummeting, and they feel the company itself dissolving into failure. They see a price soaring, and they feel the intoxicating certainty of a can't-lose success story. They have fused price and value into a single, emotionally charged entity. This fusion is the root of all financial tragedy. It is what compels people to sell their shares in a wonderful, profitable business at the moment of maximum panic, crystallizing their losses. It is what seduces them into buying a hyped-up, profitless story stock at the peak of euphoria, guaranteeing a future collapse. They are buying high and selling low, not because they are unintelligent, but because they are reacting to the wrong signal. They are listening to the price, a manic, unreliable narrator, instead of assessing the value, the quiet, steady truth of the business itself. Today, we are going to permanently sever that link. We are going to install a new operating system in your mind, a firewall that forever separates the chaotic noise of the market from the fundamental reality of a business. This is not about learning a chart pattern or a technical indicator. This is about undergoing a complete philosophical transformation, a change in your financial DNA that will allow you to achieve genuine portfolio growth, to build the kind of wealth that leads to financial freedom, by acting with serene rationality while the entire world is screaming in panic. We will deconstruct this principle into its 5 core pillars, the load-bearing walls of Warren Buffett's intellectual fortress. We will begin by meeting the imaginary business partner he created to manage his own emotions. Then, we will learn how to identify the one thing that gives a business its true, enduring value, its economic moat. From there, we will explore the single most important technique for protecting your capital, the margin of safety. We will then define the boundaries that keep you from making catastrophic mistakes, the circle of competence. And finally, we will uncover the hidden force multiplier that makes this entire system work, the concept of time arbitrage. By the end of this journey, you will no longer see a falling stock price as a reason to panic. You will see it as an invitation, an opportunity whispered to you by an irrational market, a chance to buy a piece of a great American enterprise for far less than it is truly worth. You will have internalized the final promise. Price is what you pay, but value, true, durable, compounding value, is what you actually get. Let us begin with the psychological foundation of this entire philosophy, the single most powerful allegory in the history of finance. It's a story not about numbers, but about a person, an imaginary person to be precise. His name is Mr. Market, and understanding his deeply flawed personality is the first step toward achieving investment mastery. This isn't just a cute story. It's a profound mental model for emotional regulation, a tool for achieving the CEO mindset in your own wealth management. The foundational anecdote that best illustrates the power of this concept takes us back to the early 1960s, a time of turmoil and scandal that threatened to bring down one of America's most trusted institutions. The company was American Express. At the time, its primary businesses were its iconic traveler's checks and its charge card, but it also had a lesser-known and ultimately disastrous division involved in warehousing. Specifically, it ran a field warehousing business, where it would certify the inventory of other companies, issuing warehouse receipts that those companies could then use as collateral for loans. It was a business built entirely on trust. One of its largest clients was the Allied Crude Vegetable Oil Refining Company, run by a man named Tuono De Angelis. De Angelis was a master fraudster. He claimed to have vast warehouses full of valuable salad oil, and American Express, tragically, issued the receipts confirming it. Banks, in turn, loaned De Angelis millions against this collateral. The problem was, the salad oil didn't exist. The giant tanks were mostly filled with seawater, with just a thin layer of oil floating on top to fool the inspectors. In November of 1963, the fraud was uncovered. De Angelis's company collapsed, defaulting on over $175 million in loans, an astronomical sum at the time. The banks that held the worthless warehouse receipts turned to the company that had certified them, American Express. They claimed Amex was liable for the full amount. Wall Street panicked. The story was everywhere. American Express, the bedrock of financial trust, was implicated in a massive fraud. Investors, commentators, and analysts fell over themselves to declare the company doomed. They feared that the scandal would not only lead to catastrophic financial liability, but would also shatter the public's faith in the travelers' checks and charge cards, the heart and soul of the business. The stock price, which had been trading around $60 a share, was annihilated. It plunged by nearly 50%, bottoming out around $35. This is the moment where we must pause and introduce Mr. Market. As Buffett, a student of the legendary Benjamin Graham, would describe him, Mr. Market is your imaginary business partner. You own a piece of a private business together, and every single day, without fail, Mr. Market shows up at your door and offers to either buy your share from you or sell you his share. The critical thing to understand about Mr. Market is that he is a manic depressive. Some days, he arrives in a state of wild euphoria. He sees nothing but blue skies ahead for your business. On these days, he will offer you a ridiculously high price for your share, a price that bears no resemblance to the business's underlying reality. On other days, he shows up in the depths of despair. He is convinced that everything is going to ruin, that disaster is just around the corner. On these days, he will offer to sell you his share at a ludicrously low price, desperate to get out at any cost. Mr. Market is there to serve you, not to guide you. You are free to ignore him completely. You can accept his high offer if you think it's absurd. You can buy his share from him if his low price is a bargain. Or you can simply shut the door and go about your day, confident in the long-term value of the business you own. In the winter of 1963, Mr. Market was having a full-blown psychotic breakdown over American Express. He was screaming that the company was finished, that its reputation was destroyed, that the liabilities would bankrupt it. He was offering to sell shares at $35, a price that reflected total and utter despair. The 99% of investors listened to Mr. Market. They took his emotional state as a factual analysis of the business. They heard his panic and concluded the business was failing. So they sold. They stampeded for the exits, locking in devastating losses. But Warren Buffett, then a young, relatively unknown fund manager in Omaha, did something different. He ignored the screaming. He shut the door on Mr. Market and decided to do his own research. He didn't look at the stock chart. He looked at the business. He walked into restaurants and hotels. He talked to travelers and merchants. He stood at airport check-in counters. He was trying to answer a single question. Has this scandal actually changed the fundamental behavior of American Express's customers? Is the value of the business impaired? What he discovered was that the underlying business, the true source of its value, was completely untouched. People were still using the traveler's checks. Businesses were still accepting the charge cards. The brand's power in the minds of the consumer was so strong that the warehousing scandal, as terrifying as it was to Wall Street, was a non-event for the company's actual operations. He then analyzed the financial liability. While Wall Street assumed the worst, Buffett calculated that even in a worst-case scenario, the company's powerful earning potential could easily absorb the losses. The value, he concluded, was intact. The price, however, was in the gutter. Mr. Market, in his panic, was offering to sell him $1 of real, enduring business value for less than 50 cents. So Buffett acted. He made American Express the single largest investment in his partnership, eventually committing 40% of his fund's assets to the stock. Over the next few years, as the company settled the legal claims and its powerful earnings continued to grow, the market's mood swung from despair to equilibrium, and then to its usual optimism. The stock price soared, and Buffett's partnership made a fortune. He didn't predict the market's mood swing, he simply ignored the mood and bought value. The underlying psychological principle at play here is a powerful combination of anthropomorphism and the fight against herd behavior. Anthropomorphism is our tendency to attribute human traits, emotions, and intentions to non-human entities. By creating the persona of Mr. Market, Buffett masterfully weaponizes this tendency for his own benefit. Instead of seeing the stock market as an abstract, all-knowing and intimidating force, a they who always knows more than you are encouraged to see it as a single, deeply flawed individual. This simple reframing is a psychological masterstroke. You would never let a manic-depressive friend dictate your life's most important financial decisions, so why would you let the market? This mental model creates instant emotional distance. It depersonalizes the market's movements. A 50% drop in a stock you own is no longer a personal failing or a judgment on your intelligence. It's just your crazy partner, Mr. Market, having one of his bad days. This allows you to sidestep the powerful cognitive bias of herd behavior, also known as the bandwagon effect. Humans are social creatures, hardwired over millennia to find safety in numbers. When we see a crowd running, our first instinct is not to stop and analyze the situation, but to run with them. In the financial markets, this instinct is utterly ruinous. When Mr. Market panics and sells, he creates a cascade of falling prices. This triggers the herd instinct in other investors. They see the price falling, they see others selling, and the fear of being left behind holding a worthless asset becomes overwhelming. They sell not because of a rational analysis of the business's value, but out of a primal fear of social and financial isolation. The Mr. Market allegory acts as a cognitive circuit breaker. It interrupts this instinct. When you see the herd selling American Express in 1963, your internal monologue isn't, "Oh my God, everyone is selling, I need to get out." It's, Mr. Market is in a deep depression today. I wonder if he's offering me a bargain. This shifts your perspective from that of a panicking sheep in a herd to that of a calm zoologist observing herd behavior. You are no longer part of the emotional stampede, you are a detached analyst of it. This psychological shift from participant to observer is the entire key to long-term success in stock picking. So how do you translate this into a practical, applied mental model? Here is the blueprint, the business partner test. You can apply this step-by-step process to any investment decision you ever make. Step 1. Before you ever buy a single share of a company, you must write down on a piece of paper, in 1 or 2 paragraphs, why you are buying it. This cannot be because the stock is going up or because an expert on TV recommended it. It must be a simple explanation of the business itself. What does it sell? Who are its customers? What makes it better than its competitors? This is your value thesis. For American Express, it would have been something like, Amex operates a toll bridge for commerce through its travelers, checks, and charge cards, benefiting from a powerful global brand that creates trust. This trust allows it to earn a small fee on millions of transactions, a business model that is currently unaffected by the salad oil scandal. Step 2. Identify your partner, Mr. Market. Every day, when you look at the stock price, you do not say, "My stock is down today." You must consciously and deliberately say, "Today, my partner, Mr. Market, is feeling pessimistic and is offering to sell me his share of our business at a lower price." Or, "Today, Mr. Market is feeling euphoric and is offering to buy my share at a very high price." This linguistic trick is more powerful than it sounds. It reinforces the separation between you, the rational business owner, and him, the emotional speculator. Step 3. Consult your value thesis, not the price. When Mr. Market offers you a new price, either high or low, you do not ask, "What does the market know that I don't?" You turn to your piece of paper from step 1 and ask a different question. Has anything happened today that fundamentally invalidates my original thesis about the business's value? In the case of American Express, the daily news was filled with terrifying legal headlines, but a quick check with reality, observing actual consumer behavior, showed that the core business thesis remained perfectly intact. 99% of the time, the answer to this question will be no. The daily gyrations of the stock market are noise, not signal. Step 4. Make your decision based on the opportunity, not the emotion. If your business thesis is intact and Mr. Market, in his despair, is offering you a price that is significantly below your estimation of the business's long-term value, you should consider buying more. If your thesis is intact and he, in his euphoria, is offering you a price far above what you think the business is worth, you should consider selling. And if his price is somewhere in the middle, you do the most powerful thing of all, nothing. You simply thank him for the quote and get on with your life, secure in your ownership of a fine business. This 4-step process systematically removes your ego and emotions from the decision-making loop, replacing them with a rational business owner's framework. Now, let's explore the antithesis, the path of the 99%. This is the path of the news-driven trader, the individual who has completely merged their psyche with Mr. Market. Their morning routine involves waking up and immediately checking stock futures. Their emotional state for the entire day is set by whether the screen is green or red. They listen to financial news channels not for information, but for emotional validation. When a charismatic host says the market is poised for a rally, they feel a surge of dopamine and are primed to buy. When a grim-faced analyst warns of an impending crash, they feel a jolt of cortisol and their finger hovers over the sell button. This person has no business thesis. Their thesis is simply the prevailing narrative of the day. They bought tech stocks in 1999 because the narrative was, quote, a new paradigm. They sold everything in 2008 because the narrative was financial Armageddon. They piled into meme stocks in 2021 because the narrative was to the moon. They are not investing in businesses, they are renting emotional states. Consider the dot-com bubble. The news-driven trader saw the stock price of a company like Pets.com soaring. They didn't conduct a value analysis. They didn't see a business that was spending millions on Super Bowl ads while having no clear path to profitability. They saw a price going up, and Mr. Market was euphoric. They took his euphoria as a guide, bought at the top, and were subsequently wiped out when the price inevitably collapsed to reflect the non-existent value. Fast forward to the 2008 financial crisis. The same person owned shares in a solid, profitable company like Johnson & Johnson. But the news was filled with terror. Lehman Brothers had collapsed. The entire system seemed on the brink. Mr. Market was in the deepest pit of despair, offering to buy shares of world-class businesses for pennies on the dollar. The news-driven trader, consumed by the panic, looked at the falling price of their Johnson & Johnson stock and saw not a wonderful business on sale, but a reflection of the world's fear. They sold, locking in a massive loss, only to watch the stock recover and march to new highs in the following years. This path is a surefire route to financial ruin because it forces you to do the exact opposite of what is required for success. It makes you greedy when others are greedy, and fearful when others are fearful. You are perpetually buying at the peak of optimism and selling at the trough of despair. Finally, what is the direct financial connection? How does internalizing the Mr. Market allegory manifest on your balance sheet and in your portfolio's performance? The impact is profound and multifaceted. First, you dramatically lower your transaction costs. The news-driven trader is constantly churning their portfolio, buying and selling based on emotional whims. Every transaction incurs costs, commissions, bid-ask spreads, and, most significantly, taxes. By treating Mr. Market as an occasional convenience, Rather than a constant guide, you engage in far fewer transactions. This simple act of inaction allows more of your money to stay invested and working for you. Second, you achieve superior capital gains. By buying when Mr. Market is depressed, you are systematically purchasing assets for less than they are worth. By holding them until he is euphoric, or simply for a very long time as the business value grows, you are ensuring that your gains are not just random luck, but the result of a structural advantage. You are exploiting the market's emotional volatility rather than being a victim of it. Over a lifetime, this single strategy of buying fear and selling greed is the most reliable way to beat the market averages. Third, you dramatically reduce portfolio volatility caused by your own actions. The greatest risk to most investors is not the market itself but their own reaction to it. By having a psychological buffer between market noise and your decision-making, you prevent yourself from making the single most destructive move an investor can make: selling a good asset at a bad price during a downturn. This capital preservation during crashes is just as important as the gains you make during bull runs. It is the foundation of sound wealth management. By making friends with the allegory of Mr. Market, you are not just adopting a clever tactic, you are forging a psychological shield that protects your capital, your peace of mind, and your journey toward genuine financial freedom. Now that we have established the psychological firewall to protect us from Mr. Market's emotional swings, we must address the central question he poses. If price is not the same as value, then what is value, and how do we identify it? This brings us to the second pillar of Buffett's philosophy, the single most important concept in determining the long-term success or failure of a business: the economic moat. A moat is a durable competitive advantage that protects a business from incursions by competitors, much like a moat full of alligators protected a medieval castle. It is the source of a company's intrinsic value, the reason it can generate high returns on capital year after year. Understanding how to identify a real moat is the difference between buying a wonderful business on sale and buying a melting ice cube at a discount. Our foundational anecdote for the power of a deep, understandable moat takes us to the year 1972. Buffett, through his holding company Berkshire Hathaway, was presented with an opportunity to buy a chocolatier based in California called See's Candies. On the surface, it was an unremarkable business. It was old-fashioned, sold a simple product, and had limited growth prospects beyond the West Coast. To the high-flying financiers of Wall Street, who were chasing electronics companies and conglomerates, a candy company seemed pedestrian, a relic of a bygone era. The sellers wanted $30 million for the company. Buffett's partner, Charlie Munger, was immediately interested, but Buffett hesitated. His rigorous, quantitative-focused brain, honed by years of Benjamin Graham's cigar butt investing, saw a company with tangible assets, factories, stores, inventory, worth only about $8 million. Paying $30 million meant paying a $22 million premium for something intangible, something that didn't appear on the balance sheet. This goodwill was precisely the kind of fuzzy concept his mentor had taught him to avoid. But Munger pushed him to look deeper, not at the assets, but at the business itself. What they discovered when they analyzed See's Candies was not a collection of buildings and equipment, but a fortress of a business protected by one of the most powerful moats in existence: brand. See's had been operating in California for over 50 years. For generations, its distinctive black and white boxes were the go-to gift for birthdays, Valentine's Day, and Christmas. The taste of a See's candy was intertwined with customers' most cherished memories. This created a level of customer loyalty that was almost unbreakable. A competitor could build a more modern factory, open shinier stores, or even, arguably, make a slightly better-tasting chocolate. But they could not replicate the half-century of positive emotions and traditions that were baked into the See's brand. This powerful brand gave See's Candies something extraordinary: pricing power. Each year, the company could raise its prices to cover inflation and then some, and the customers would happily pay it. They weren't just buying chocolate. They were buying a sense of nostalgia, tradition, and guaranteed quality. The thought of showing up to a family Christmas gathering with a generic box of drugstore chocolates was unthinkable for a loyal See's customer. This pricing power, this ability to raise prices without losing customers, was the economic reality of the brand moat. Buffett realized that the $22 million in goodwill was not some fuzzy accounting fiction. It was the capitalized value of this incredible competitive advantage. He and Munger went ahead and bought the company for $25 million. Over the decades that followed, See's Candies became a case study in the power of a great moat. It has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, earnings that required very little additional capital investment. It was, as Buffett would later call it, the all-American business. It didn't need to invent a new technology or disrupt an industry. It just needed to keep making good chocolate and nurturing the powerful brand moat that allowed it to function as an unregulated toll bridge on its customers' emotions. The See's Candies acquisition marked a crucial evolution in Buffett's thinking, moving him from Graham's approach of buying fair companies at wonderful prices to his own philosophy of buying wonderful companies at fair prices. And the definition of a wonderful company is one with a wide, sustainable economic moat. The underlying psychological principle that makes a moat like the one See's Candies possesses so powerful is a blend of the endowment effect and status quo bias. The endowment effect is our tendency to overvalue things that we own or feel a connection to. For a See's customer, the brand isn't just a product choice, it's asterisk their chocolate company. It's part of their identity, their family traditions. This sense of ownership makes them psychologically resistant to switching to a competitor, even if that competitor offers a lower price. The competitor isn't just asking them to try a new chocolate, they're asking them to betray a small piece of their personal history. This effect is magnified by status quo bias, which is our innate preference for the current state of affairs. Making a new choice requires cognitive effort and carries the risk of regret. If the new chocolate isn't as good, the customer will feel foolish. It's simply easier and safer to stick with the tried and true. A strong brand moat weaponizes this cognitive laziness. It makes sticking with the incumbent the path of least psychological resistance. Think about another powerful brand moat: Coca-Cola. For over a century, the company has spent billions of dollars not just advertising its product, but associating it with happiness, family, and celebration. When you reach for a Coke, you aren't just making a beverage choice, you are activating a dense network of positive associations built up over a lifetime. A competitor like Pepsi can spend a fortune on taste tests and celebrity endorsements, but they struggle to overcome the deep-seated psychological inertia of the Coke brand. A company with a strong moat doesn't have to constantly fight for its customers. Their customers' own psychological biases do the fighting for them. This creates a stable, predictable stream of earnings that is the hallmark of a truly valuable business. It's a critical concept for any entrepreneur or CEO to understand. Building a business isn't just about a great product. It's about embedding that product into the customer's life so deeply that leaving becomes a psychologically painful act. So how can you, as an investor or a business leader, translate this into an applied mental model? Here is the blueprint, the moat identification checklist. Before investing in a company or formulating a business strategy, you must be able to identify and articulate the specific type of moat it possesses. There are generally 5 major types. First, intangible assets. This includes brands, like See's Candies or Coca-Cola, as well as patents and regulatory licenses. A pharmaceutical company with a patent on a blockbuster drug has a powerful, albeit temporary, moat. A utility company with an exclusive government license to provide electricity in a region has an almost permanent one. The key question to ask is, does this company have a name, right, or permission that prevents competitors from offering the same product? Second, a cost advantage. This is when a company can produce and deliver its goods or services at a lower cost than its rivals. This can come from superior processes, like the Toyota production system, or from massive scale, like Walmart's ability to demand lower prices from its suppliers. The question here is, can this company sell its product at the same price as competitors and earn a higher margin, or sell at a lower price and capture market share? A great example in the modern era is Amazon's vast network of fulfillment centers, which creates a delivery cost advantage that is nearly impossible for rivals to replicate. Third, a switching cost moat. This exists when it is too expensive, time-consuming, or risky for a customer to switch from one product to another. Think about the software that runs a bank's core operations. Even if a better, cheaper alternative comes along, the risk of data loss and operational disruption during the switch is so high that the bank will stick with the incumbent provider for years, even decades. For your analysis, ask, would a customer have to endure significant pain, cost, or effort to switch to a competitor? Microsoft Office has a powerful switching cost moat built on user familiarity and file compatibility. Fourth, the network effect. This occurs when the value of a product or service increases as more people use it. The classic example is a telephone network. One phone is useless, but a billion phones create immense value for every user. In the digital age, this is perhaps the most powerful moat of all. Social media platforms like Facebook, marketplaces like eBay, and credit card companies like Visa and MasterCard all benefit from it. The more users and merchants that accept Visa, the more valuable it becomes for both groups, creating a virtuous cycle that is incredibly difficult for a new competitor to break into. The question is, does the product become more valuable to me as more people join? Fifth, efficient scale. This applies in smaller markets where there is only enough demand to support one or two players profitably. A railroad that owns the only track between two cities has a moat of efficient scale. A new competitor would have to spend billions to lay a new track, only to split a market that can barely support the first one. This creates a natural monopoly. When you analyze a business, you must be able to point to one or more of these specific moats and explain, in simple terms, how it protects the company's profitability. If you can't, no matter how exciting the story or how fast the revenue is growing, you are likely looking at a business with no durable value. Now let's look at the antithesis, the path of the 99%, the growth at any price gambler. This individual is mesmerized by exciting narratives and soaring revenue figures, but pays zero attention to the sustainability of that growth. They are drawn to companies in hot industries, companies that promise to change the world, without ever asking the crucial question, once you change the world, how will you stop someone else from coming in and taking all the profits? The dot-com bubble is the ultimate cautionary tale. Investors piled into companies like Webvan, an online grocery delivery service. The growth story was intoxicating. They were going to revolutionize the way people buy food. They raised hundreds of millions of dollars, built massive, sophisticated warehouses, and bought a fleet of trucks. Revenue grew at a blistering pace. The stock soared. But the gambler never stopped to analyze the moat. What was stopping a traditional grocery store chain, with its existing supply chain and physical footprint, from simply adding a delivery service? What was Webvan's durable competitive advantage? The answer was nothing. They had no brand loyalty to speak of, no cost advantage. In fact, their costs were astronomical, no switching costs, and no network effect. They were simply a new business in a brutally competitive, low-margin industry. When the capital ran out and the narrative faded, the company collapsed into bankruptcy, and investors who had chased the growth story lost everything. The same pattern repeats in every market cycle. Investors get excited about 3D printing, cannabis, electric vehicles, or artificial intelligence. They buy the companies with the most exciting stories, pushing their stock prices to levels that assume decades of flawless, unimpeded growth. But they fail to do the hard work of moat analysis. They don't differentiate between a company that is merely participating in a growth trend and one that has a structural advantage that will allow it to capture a disproportionate share of the profits from that trend for a long time. They are buying growth, but they are getting no value. The direct financial connection of moat analysis is crystal clear when you look at a company's financial statements. A company with a wide moat consistently produces high returns on invested capital, or ROIC. ROIC measures how much profit a company generates for every dollar of capital that has been invested in the business. A company with no moat might have to spend $1 of capital to build a new factory just to generate 5 cents of annual profit. This is a low ROIC business. A company like See's Candies with its brand moat can generate huge profits with very little additional capital. Its ROIC is enormous. This is the financial fingerprint of a great business. Furthermore, a strong moat leads to predictable and growing free cash flow. Because the company isn't constantly fighting off competitors in brutal price wars, its margins are stable and its earnings are consistent. This cash can then be used to pay dividends, buy back shares, or reinvest in strengthening the moat further, all of which directly benefit the shareholders. When you perform a stock analysis, looking for a history of high and stable ROIC and consistent free cash flow is a quantitative way of confirming the qualitative existence of a moat. It transforms the abstract concept of a competitive advantage into hard numbers on a page. This is the crucial link between business strategy and shareholder returns. An executive decision-making process that prioritizes widening the company's moat is one that is fundamentally aligned with long-term wealth creation. It's the difference between building a business on sand and building it on bedrock. We've established a psychological shield with Mr. Market and learned how to identify true business value through the concept of the economic moat. Now we arrive at the third pillar, the critical junction where theory meets practice, where analysis turns into action. This is the pillar that directly protects your capital and provides the explosive upside that defines value investing. It is the principle of the margin of safety. The concept is simple to state, but profound in its application. You must only buy a security when its market price is significantly below your calculation of its intrinsic value. You are not trying to buy $1 of value for 95 cents. You are trying to buy $1 of value for 50 cents. This gap, this discount, is your margin of safety. It is the buffer that protects you from bad luck, market volatility, and, most importantly, your own inevitable errors in judgment. No analysis is perfect. The future is inherently uncertain. The margin of safety is the explicit acknowledgement of this reality. It is the financial equivalent of an engineer building a bridge that can hold 3 times the maximum expected weight. It ensures that even if things don't go exactly as planned, you still don't lose money. Our foundational anecdote for the margin of safety is one of Buffett's earliest and most famous investments, the Washington Post Company in 1973. The stock market at the time was in the midst of a brutal bear market, often called the Nifty 50 crash. The mood on Wall Street was sour, and newspaper stocks, in particular, were seen as stale, low-growth businesses. The entire Washington Post Company, which included the flagship newspaper, Newsweek magazine, and several valuable television stations, had a total stock market valuation of about $80 million. Buffett, as was his practice, ignored Mr. Market's pessimistic valuation and set about calculating his own estimate of the company's intrinsic value. He didn't use a complex spreadsheet. He used simple, conservative business owner logic. He looked at the individual assets of the company as if he were buying them in a private transaction. He knew that a single major network television station in a big city was worth at a bare minimum $100 million, and the Washington Post Company owned 4 of them. He could have stopped right there. The television stations alone were worth more than the entire company's stock market price. But he kept going. He conservatively valued the newspaper, Newsweek, and the other assets. His final, back-of-the-envelope calculation put the intrinsic value of the entire enterprise somewhere between $400 and $500 million. And yet the stock market, in its wisdom, was offering to sell him the entire company for just $80 million. The price was $80 million. The value was at least $400 million. This wasn't just a small discount, it was a chasm. He was being offered the chance to buy $1 of prime American media assets for 20 cents. This massive gap was his margin of safety. It meant that so many things could go wrong, and he would still be fine. The newspaper circulation could decline. Newsweek could face tougher competition. the economy could enter a deeper recession. All of these things could happen, and his investment would still be protected by the enormous discount at which he had bought in. Of course, he didn't just analyze it, he acted decisively. Berkshire Hathaway began buying shares, eventually investing nearly $11 million to acquire a large stake in the company. That investment would become one of the cornerstones of Berkshire's success. Over the next 30 years, the Washington Post company, led by the brilliant Katharine Graham, flourished. That initial $11 million investment would eventually become worth over $1 billion, a return of more than 100 times his initial capital. This legendary success was not due to some magical ability to predict the future of the newspaper industry. It was rooted entirely in the discipline of demanding a massive margin of safety. He didn't need the future to be perfect, he just needed it to not be a complete catastrophe, and the initial price he paid did the rest of the work. The underlying psychological principles that the margin of safety helps an investor overcome are loss aversion and anchoring. Loss aversion is a cornerstone of behavioral economics, demonstrating that for most people, the psychological pain of losing a dollar is about twice as powerful as the pleasure of gaining a dollar. This profound asymmetry makes investors inherently risk-averse in the worst possible way. When a stock they own starts to fall, the pain of those paper losses becomes acute. Loss aversion screams at them to sell and make the pain stop, leading them to lock in losses at the bottom. Conversely, it makes them terrified to buy a stock that has already fallen significantly. Because they associate it with pain and loss, they fear it will keep falling. A margin of safety is a rational antidote to this emotional poison. It reframes the decision. You are not catching a falling knife. You are methodically purchasing an asset at a substantial discount to its real worth. The focus shifts from the fear of the price falling further to the confidence of the value you are acquiring. It provides the courage necessary to act when fear is rampant. The second bias it combats is anchoring. This is our tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. In investing, investors often anchor to a stock's recent high price. If a stock was trading at $100 a few months ago and is now at $50, many investors will view it as broken, or will wait for it to show some strength before buying. They are anchored to the $100 price. A disciplined value investor ignores that anchor. The past price is irrelevant. The only thing that matters is the current price relative to the current intrinsic value. The margin of safety forces you to create your own anchor, your calculated intrinsic value, and then make decisions based on the spread between that anchor and the market price. By creating your own rational anchor, you liberate yourself from the market's irrational and emotional one. Buying Washington Post at a market cap of $80 million was possible only for someone who could completely disregard the fact that it had been valued higher in the past, and instead focus solely on the fact that it was worth at least $400 million right now. The applied mental model for this pillar is the back-of-the-envelope valuation. This isn't about creating a 100-tab spreadsheet with projections out to the year 2050. It's about developing a rough, conservative estimate of a business's worth that is so obvious it practically hits you over the head. Here is a simplified blueprint. Step 1. Frame the question correctly. You are not trying to predict the exact value of a business. You are trying to determine a range of value that is reasonable. The question is not, is this business worth exactly $73.50 per share? The question is this business obviously worth a lot more than its current price of $30 per share? If the answer isn't an obvious yes, you move on. Step 2. Use multiple, simple valuation methods. Don't rely on a single metric. First, look at the liquidation value. What would the assets of the company, its cash, buildings, inventory, be worth if it were shut down tomorrow? This provides a hard floor for the value. Second, look at the earnings power value. A simple way to do this is to take the company's average, sustainable annual earnings and multiply it by a reasonable number, say 15. This gives you a rough idea of what a private buyer might pay for the entire business. For a great growing business, you might use a higher multiple. For a stagnant one, a lower one. Third, look at private market value. What have similar businesses been sold for in private transactions or acquisitions recently? This can provide a powerful reality check. For the Washington Post, Buffett's primary method was a private market valuation of its individual assets. Step 3. Be brutally conservative. In every one of your assumptions, err on the side of caution. Use the company's lowest earnings of the last few years, not its highest. Use a lower multiple than you think is fair. Assume its growth will be slower than management projects. You are actively trying to prove the business is asterisk, not perhaps a bargain. The goal is to create a valuation that you are supremely confident is an underestimate of the true value. Step 4. Demand the discount. Once you have your conservative range of intrinsic value, say you are confident the business is worth between $80 and $100 per share, you compare it to the current price. If the stock is trading at $75, you do nothing. There is no margin of safety. If it's trading at $40, you have a massive margin of safety, and it's time to consider investing. This process transforms investing from a speculative guessing game into a disciplined business practice. You are no longer hoping the price goes up. You are relying on the powerful tailwind of buying value at a steep discount. The antithesis to this disciplined approach is the path of the 99%, which manifests in two equally destructive behaviors, the knife catcher and the FOMO buyer. The knife catcher sees a stock price falling and assumes it must be cheap. They buy a stock that has fallen from 50 to 25, thinking they got a 50% discount. They buy again at 12 and again at 6, averaging down all the way to bankruptcy. Their mistake is that they are focused exclusively on the falling price without ever performing the crucial second step, valuing the underlying business. They are catching a falling knife because the intrinsic value of the business is falling even faster than the price. Think of a company like BlackBerry and its decline. The stock price fell precipitously for years. At every stage, knife catchers would jump in, claiming the stock was too cheap relative to its past highs. But they failed to realize that the intrinsic value of its business was evaporating as the iPhone and Android ecosystems took over the entire market. There was no margin of safety because the value was a moving target, heading straight for zero. On the opposite end of the spectrum is the FOMO buyer. FOMO, or the fear of missing out, drives investors to buy stocks that are soaring in price, regardless of their underlying valuation. They see a stock like Tesla or Nvidia making new highs day after day, and the fear of being the only one not getting rich becomes unbearable. They throw all valuation discipline out the window and buy at any price, just to be part of the excitement. Their justification is that, this time it's different. Or, you can't value a disruptive company with old metrics. They are paying $1 for 50 cents or even 20 cents of tangible value, hoping the story will carry them through. This is a strategy built on pure hope, the polar opposite of the margin of safety, and it is almost always punished when the narrative eventually collides with financial reality. Both the knife catcher and the FOMO buyer are slaves to price, one to falling prices, the other to rising ones. Neither is acting like a business owner. The direct financial connection of the margin of safety is perhaps the most powerful of all the pillars. It directly creates the potential for massive, asymmetric returns. An asymmetric bet is one where the potential upside is many times larger than the potential downside. When you buy $1 of value for 50 cents, your downside is arguably limited to that 50 cents, assuming your valuation isn't completely wrong. However, your upside is not just back to $1. If it's a great business, that intrinsic value will continue to grow over time, to $2, then $5, then $10. Your potential gain is a multiple of your potential loss. This is how true wealth is built. The Washington Post investment was a classic asymmetric bet. The downside was perhaps a loss of 20 or 30% if things went poorly. The upside, as it turned out, was 10,000%. This principle is the bedrock of capital preservation. The first rule of successful wealth management is don't lose money. The margin of safety is the practical application of that rule. By ensuring you have a buffer in every investment, you protect your capital from permanent loss during market downturns, allowing it to survive and compound for another day. It directly impacts your long-term capital gains by maximizing your entry point. The lower the price you pay, the higher your eventual return will be. It is the active, disciplined pursuit of buying wonderful businesses on sale, and it is the single most reliable way to build a portfolio that can withstand the inevitable storms of the market and deliver life-changing growth over the long term. We have now assembled 3 of our 5 pillars. We have a psychological defense against market madness, a method for identifying high-quality businesses, and a discipline for buying them at a discount. But there is a hidden danger, a subtle trap that can cause even the most diligent student of this philosophy to fail. Simply finding a company with a strong moat that is trading for a low price is not enough. You can follow all the steps correctly and still end up with a catastrophic loss if you neglect the 4th, and perhaps most personal pillar, the circle of competence. This principle states that you don't have to be an expert on every company, or even many. You only have to be able to correctly evaluate the companies that you do buy. Therefore, your lifelong task as an investor is to clearly define the perimeter of what you know and understand, and then to have the discipline to stay strictly within it. It's a philosophy built on intellectual humility, a recognition that your analytical ability has limits. True investment success is found not in expanding that circle endlessly, but in knowing exactly where the edge is and never stepping over it, no matter how tempting the opportunity on the other side may seem. The foundational anecdote for the circle of competence is not about a brilliant investment Warren Buffett made, but about the thousands of investments he famously didn't make. The story takes place in the late 1990s, during the height of the dot-com bubble. The world was intoxicated with the promise of the internet. Companies with .com at the end of their names, many with no revenue and no profits, were soaring to astronomical valuations. Technology stocks were the only game in town. Buffett, meanwhile, was being publicly ridiculed. He was called a dinosaur, a relic from a bygone era who didn't get it. Barron's, a major financial publication, ran a cover story in 1999 titled, "What's Wrong, Warren?" asking if he had lost his touch. His company, Berkshire Hathaway, was dramatically underperforming the red-hot NASDAQ index. Investors were dumping his stock to chase the latest tech darlings. Through all of this intense pressure and public scorn, Buffett remained completely steadfast. He didn't buy Intel, he didn't buy Microsoft, he didn't buy Cisco. He didn't buy any of the tech giants that were fueling the boom. His reasoning was shockingly simple, and he stated it openly. He said, "I don't know what those companies will look like in 10 years. I have no idea." He wasn't saying they were bad companies. He wasn't even saying they were overvalued. He was making a statement of pure intellectual honesty. They were outside his circle of competence. He understood the economics of candy companies, insurance firms, newspapers, and soda brands. He could look at a business like Coca-Cola and have a very high degree of confidence about what its competitive position and earnings would look like a decade or 2 into the future. But with technology companies, he couldn't. The pace of change was too fast, the competitive landscape too uncertain. He couldn't tell which chip manufacturer would have the dominant technology in 10 years or which software company would be obsolete. Because he couldn't confidently project their long-term future, he couldn't confidently calculate their intrinsic value. And if he couldn't calculate their intrinsic value, he couldn't know if he was getting a margin of safety. So he did nothing. He patiently sat on the sidelines, holding cash and his collection of boring businesses, and watched the party rage on. Then, in the spring of 2000, the bubble burst. The NASDAQ, which had peaked above 5,000, began a catastrophic collapse, eventually losing nearly 80% of its value. Hundreds of dot-com companies went bankrupt. Trillions of dollars of speculative wealth were vaporized. Investors who had mocked Buffett just months earlier were financially ruined. Buffett, meanwhile, had preserved his capital. He had not only avoided the crash, but was now sitting on a mountain of cash in a world where great assets were suddenly on sale. His decision to stay within his circle of competence was not an offensive move to make money, but a defensive one to avoid losing it. And in the long run, avoiding the big mistakes is even more important than scoring the big wins. He looked foolish for a couple of years, but he preserved the capital that would allow him to be brilliant for the next 2 decades. The underlying psychological principles at play here are the Dunning-Kruger effect and the battle against overconfidence bias. The Dunning-Kruger effect is a cognitive bias whereby people with low ability at a task overestimate their ability. In investing, a little bit of knowledge can be a dangerous thing. An investor might read a few articles about biotechnology, learn a few industry buzzwords, and suddenly believe they are qualified to pick the winning drug stocks. They don't know enough to realize how much they don't know about clinical trial phases, patent law, and the complexities of FDA approval. The circle of competence is a direct antidote to this. It forces you to ask not, "Do I know a little bit about this?" but, "Am I truly an expert or close to it?" It demands a level of self-awareness that is rare in a field dominated by ego. This is directly tied to overconfidence bias, our tendency to be more confident in our own abilities than is objectively reasonable. After a few successful investments, it's easy for an investor to believe they have a golden gut, a special intuition for picking winners. This overconfidence leads them to stray into new, unfamiliar areas, assuming their past success will automatically translate. They might have made money in retail stocks, and then decide to speculate on oil futures or Chinese tech companies, areas where they have no real analytical edge. The circle of competence is a rule-based system designed to constrain this ego-driven exploration. It's a pre-commitment to intellectual humility. It's a way of saying, "I know that my future self will be tempted by greed and overconfidence, so I am setting this boundary for myself right now, while I am calm and rational." How do you apply this? The blueprint is the competence mapping exercise. This is a personal inventory, a written document that you create and refer to throughout your investing life. Step 1. Identify your areas of genuine expertise. This doesn't have to be your profession, but it often is. Are you a doctor? Your circle might include healthcare companies. A software engineer? You have an edge in understanding enterprise software. A banker? You understand the economics of financial institutions better than most. List the industries or business models where your knowledge is deep and granular. You should be able to explain how the business works, who its main competitors are, and what its key drivers of profitability are, as if you were explaining it to a 10-year-old. Step 2. Identify your areas of interest and learning. These are subjects where you are not yet an expert, but you are actively and seriously studying them. Maybe you're fascinated by the logistics industry. You can put this on a learning list, but you are forbidden from investing in it until you have put in the hundreds of hours of reading and research required to move it into your core circle. This creates a structured way to expand your competence over time, rather than just chasing whatever is hot. Step 3. Explicitly list your areas of ignorance. This is the most important step. Be brutally honest with yourself. I do not understand biotechnology. I do not understand macroeconomic forecasting. I do not understand the semiconductor industry. Write them down. By explicitly naming the areas you will avoid, you create a powerful defense against future temptation. When a friend comes to you with a can't-miss tip on a small biotech firm, you can simply refer to your document and say, "That's outside my circle. I'm not going to play." Step 4. Test the perimeter. For any potential investment, even one you think is inside your circle, subject it to a simple test. Could you confidently debate the long-term bull case and the long-term bear case for this company with an industry expert? Could you explain to your spouse or a trusted friend in 5 minutes exactly why this business will be more profitable in 10 years? If the answer is no, then you haven't done enough work, and it's not truly inside your circle yet. This exercise creates a living, breathing map of your own mind, guiding your capital towards the areas where you have a genuine analytical advantage and away from the speculative quicksand where you are simply gambling. The antithesis is the path of the 99%, embodied by the jack-of-all-trades, master-of-none investor. This person's portfolio is a chaotic reflection of the last 6 months of financial headlines. In one corner, they have a few shares of a cryptocurrency they bought after hearing about it at a party. Next to it is a cannabis stock that was hyped on a Reddit forum. Over here is a Chinese electric vehicle company they read about in an article. They have no deep knowledge of any of these things. They don't understand blockchain technology, the regulatory landscape for cannabis, or the competitive dynamics of the Chinese auto market. Their research consists of reading a few bullish articles or watching a YouTube video. They have mistaken familiarity with a story for genuine competence. This approach is doomed to fail because it ensures they will always be the patsy at the poker table. In every one of those specialized fields, they are competing against obsessive experts who have dedicated their lives to understanding that single ecosystem. The biotech hedge fund manager will always know more about drug trials. The venture capitalist will always know more about a tech startup. By dabbling in everything, this investor guarantees they have no edge in anything. They are constantly making decisions with inferior information and a superficial level of understanding. They are destined to buy high when the story is popular and well-known, and sell low when some unforeseen nuance of the industry, which would have been obvious to an expert, causes the stock to collapse. Their portfolio is a museum of past fads, a testament to the high cost of intellectual tourism. The direct financial connection of staying within your circle of competence is profound. First, it dramatically lowers your error rate. The vast majority of large investment losses come from venturing into unknown territory. By sticking to what you know, you are statistically less likely to make a fatal analytical mistake. You are less likely to be surprised by a competitive threat or a technological shift that you didn't see coming. This capital preservation is paramount. Second, it leads to higher conviction. Because you understand the businesses you own so deeply, you are less likely to be shaken out of them during a market panic. When the stock of a company you know inside and out falls 30%, you are able to calmly re-examine your thesis and, if it remains intact, confidently buy more. The investor who owns it as a superficial hot tip will panic and sell at the worst possible time. This high conviction allows you to make larger, more concentrated investments in your best ideas, which is a key driver of superior long-term returns. A well-managed portfolio isn't 100 random lottery tickets. It's a small number of well-understood high-probability bets. Finally, it creates a more efficient use of your most valuable asset, your time. Instead of wasting hundreds of hours trying to become a superficial expert in a dozen different fields, you can focus your energy on deepening your knowledge within your core circle. This creates a virtuous cycle where your analytical edge gets sharper and sharper over time, further improving your decision-making and your financial results. It is the ultimate embodiment of the CEO mindset, focusing your resources on the areas where you can achieve a decisive and sustainable advantage. We have arrived at the fifth and final pillar. This is the catalyst, the secret ingredient that activates the full power of the other four. You can have the emotional discipline to ignore Mr. Market, the analytical skill to identify a great moat, the prudence to demand a margin of safety, and the humility to stay within your circle of competence. But without this final piece, the entire structure can still crumble. The fifth pillar is the principle of time arbitrage, which is the practice of exploiting the market's obsession with short-term performance by adopting a radically long-term time horizon. In a world where professional money managers are judged on their quarterly performance and high-frequency traders operate in microseconds, the individual investor has one enormous structural advantage. You don't have a mandatory holding period. You can afford to be patient. You can buy a piece of a wonderful business at a fair price and then simply wait. You can allow the value to compound and the market price to eventually reflect that underlying growth, without being forced to sell at an inopportune time. This patience is not passive, it is an active, strategic weapon. Our foundational anecdote for the power of time arbitrage is Buffett's monumental investment in the Coca-Cola Company in 1988. This story is particularly powerful because it happened after a major market crash, the infamous Black Monday of October 1987, when the Dow Jones Industrial Average fell over 22% in a single day. Panic was in the air. Investors were terrified that a new Great Depression was imminent. Mr. Market was in a state of extreme despair, and the prices of even the world's greatest companies were being marked down. Buffett, armed with his other principles, saw this not as a crisis, but as the opportunity of a lifetime. He had long admired Coca-Cola. He saw a company with one of the most powerful moats in history, a global brand that was synonymous with the product itself. He saw a simple, understandable business that was well within his circle of competence. But for years, the stock had been too expensive. Mr. Market was always euphoric about Coke's prospects. After the crash of '87, that changed. The price fell, not because anything was wrong with the business of selling sugar water, but because of a general market panic. This provided him with the margin of safety he required. Over a period of several months in 1988, Berkshire Hathaway began to buy Coca-Cola stock, and they didn't just nibble, they bought aggressively, investing over $1 billion to acquire about 7% of the entire company. It was a massive, concentrated bet. But here is where the fifth pillar comes into play. Buffett did not buy Coca-Cola with the intention of selling it in a year or two when the price recovered. He announced his intention very clearly. This was a permanent holding. He was not renting the stock. He was buying the business. He was using a time horizon not of quarters or years, but of decades. He saw the incredible runway for growth as Coke expanded into emerging markets around the world. He understood that the real money would be made not from the stock price bouncing back from the crash, but from the decades of compounding earnings that lay ahead. And so, he held. And held. And held. He held through the recession of the early 1990s. He held through the Asian financial crisis of 1997. He held through the dot-com bust of 2000. He held through the financial crisis of 2008. He held through countless panics, wars, and economic downturns. That $1 billion investment, through stock splits and dividends, is today worth well over $25 billion. The annual dividend that Berkshire receives from Coca-Cola today is a significant portion of their original purchase price. This staggering success was not achieved by clever market timing or trading. It was achieved by combining the first four pillars with the fifth, a multi-decade time horizon. He let the extraordinary power of compound interest do the heavy lifting, protected by the company's durable moat. He exploited the market's short-term focus to acquire a long-term compounding machine. The underlying psychological principle that time arbitrage allows us to conquer is hyperbolic discounting, our brain's powerful, innate preference for immediate rewards over larger, delayed rewards. This is why people choose to eat a donut now rather than have better health in the future, or why they'll take $500 today over $1,000 in a year. Our brains are not naturally wired for long-term thinking. Financial markets amplify this cognitive flaw to an extreme degree. Professional fund managers are under immense pressure to show good performance every single quarter. If they underperform for even a few quarters in a row, their clients will pull their money. This forces them to focus on stocks that are likely to go up in the next 3 to 6 months, not the next 3 to 6 years. High-frequency traders and day traders take this to another level, chasing profits on a timescale of minutes or seconds. They are all playing a short-term game. Time arbitrage is the conscious decision to refuse to play that game. By adopting a 5, 10, or even 20-year time horizon, you are entering a competition that almost no one else is playing. You are no longer trying to predict what a stock's price will be next week. You are trying to ascertain what the business's value will be in the next decade. This is a far easier and more reliable question to answer. It allows you to ignore the chaotic short-term noise and focus on the powerful long-term fundamentals, the strength of the moat, the quality of the management, and the growth of the underlying earnings. You are trading your need for instant gratification for the far greater reward of long-term compounding. This is a profound competitive advantage, available to any retail investor, that is structurally denied to most professionals. The applied mental model for this is the 10-year test. It's a simple but powerful filter to apply to any potential investment, forcing you into a long-term mindset. Here is the blueprint. Step 1. Before buying a single share, ask yourself this question. If the stock market were to close for the next 10 years, starting the day after I buy this stock, would I be comfortable and happy owning this business? This immediately shifts your focus from the stock price to the business itself. You are no longer thinking about whether the stock will go up next month. You are forced to think about the durability of the company's moat, the competence of its management, and its ability to generate cash flow over a full decade. If the thought of being locked into owning this business for 10 years makes you nervous, you should not own it for 10 minutes. Step 2. Project the business, not the stock price. Take out a piece of paper and write down what you realistically expect the business to look like in 10 years. Will its revenues be higher? Will its profit margins be wider? Will it have more customers? Will its competitive advantage be stronger or weaker? Be specific. For Coca-Cola in 1988, the projection might have been, in 10 years, Coke will have significantly expanded its presence in Europe and Asia, its brand will be even more dominant, and it will be selling billions more servings of its products at higher prices. This is a business-focused projection. Step 3. Hold yourself accountable. After you buy the stock, put that piece of paper away. A year later, pull it out. Are things tracking in the right direction? Not the stock price, but the business fundamentals. This prevents you from being swayed by short-term market sentiment. As long as the business is progressing along the path you laid out, the fluctuations of the stock price are just Mr. Market's mood swings. The 10-year test transforms you from a stock renter into a business owner. It is the ultimate litmus test for a true long-term investment. The antithesis path of the 99% is the day trader's fallacy. This is the belief that one can consistently profit from predicting short-term market movements. The day trader is the polar opposite of the time arbitrageur. Their time horizon is minutes, not decades. They are obsessed with chart patterns, technical indicators, and the minute-to-minute flow of news. They believe they can outsmart the market's short-term randomness. This is a fool's errand. The short-term direction of the stock market is functionally a random walk. For every genius trader you hear about, there are thousands who have quietly blown up their accounts and disappeared. The day trader's fallacy is seductive because it promises the instant gratification our brains crave, quick profits, and the thrill of action. But it is a path paved with high transaction costs, immense stress, and for the overwhelming majority, devastating losses. Consider the person who tries to day trade a stock like Apple. They buy it at 9:30 in the morning, hoping to sell it for a 1% gain by noon. Their decision is based on some squiggly line on a chart or a rumor on a message board. They are competing against supercomputers and PhDs in quantitative finance who are all trying to do the same thing. The long-term investor, meanwhile, buys Apple because they believe in the power of its ecosystem, its brand moat, and its ability to generate enormous cash flows over the next decade. The day trader is playing a zero-sum game of chance against the world's smartest players. The long-term investor is partnering with one of the world's greatest businesses and letting them do the work. The day trader is trying to catch lightning in a bottle. The long-term investor is planting an oak tree. The direct financial connection of time arbitrage is the single most powerful force in all of finance, the magic of compound interest. When you hold a great business for decades, you don't just earn a return on your initial capital, you earn a return on your returns. And then you earn a return on asterisks, those times returns. Over time, this process creates exponential, not linear, growth. A $10,000 investment that grows at 10% per year is worth about $26,000 after 10 years. But after 30 years, it's not $78,000. It's over $174,000. The majority of the gains come in the later years. By trading in and out of stocks, you are constantly interrupting this compounding process and resetting it to zero. Furthermore, a long-term approach has massive tax advantages. In the United States, investments held for more than a year are taxed at a much lower long-term capital gains rate. Short-term trades are taxed as ordinary income, which can be more than double the long-term rate. By simply extending your holding period, you are legally and ethically shielding a huge portion of your portfolio growth from taxes. This difference alone can add hundreds of thousands or even millions of dollars to your net worth over an investing lifetime. Time arbitrage, therefore, directly impacts your final financial outcome by unleashing the full power of compounding and minimizing the corrosive effects of taxes. It is the final, crucial element that allows you to translate the principles of value investing into a machine for building generational wealth. You have just completed a journey into the very heart of the world's most successful investment philosophy. You have acquired more than just information. You have been given the blueprint for a complete mental operating system for wealth creation. You now possess the foundational lens of the world's greatest investor, the one that separates all of his decisions from the emotional chaos of the crowd. It is the mental firewall that forever separates price, the frantic, daily noise, from value, the steady, long-term truth. You understand that Mr. Market is your servant, not your master. You know that the source of true value lies in a durable economic moat. You have the discipline to demand a margin of safety and the humility to operate only within your circle of competence. And you have been given the ultimate weapon to make it all work, the strategic patience of time arbitrage. This is a powerful, integrated system of thought that, if applied with discipline, can fundamentally change your financial destiny. But this is the critical moment of your journey. This firewall, this lens, is only the first component in a much larger machine. It is the engine, but an engine needs a transmission, a chassis, and a steering wheel to become a vehicle. Knowing what to look for is one thing. Knowing how to value it with precision, when to deploy capital most effectively, and how to structure a portfolio that balances risk and reward are entirely different, interlocking systems. The video that is now appearing on your screen is not a random suggestion. It is not an algorithm's guess. Think of it as the next page in the blueprint. It is the gear that connects the engine you have just built to the wheels. It is the link that connects the what to the how much. The bridge from identifying a great business to calculating the precise price that turns it into a life-changing investment. Many people will stop here, content with the theory, armed with a new sense of intellectual comfort. But for those on the path to genuine financial freedom, for those who are serious about cultivating a true CEO mindset over their own capital, the journey does not end with the first step. The decision to click is more than just a decision to watch another video. It is a declaration of your intent to complete the machine, to build your full mental arsenal. Continue your ascent.